Ever wondered how a decision made thousands of miles away can impact the money in your pocket? Let's take a moment to understand this intricate relationship between the global economy and financial markets. Picture the world as a giant interconnected web, where a ripple in one corner can create waves across the entire network. In this vast network, the global economy and financial markets are two crucial components that are constantly influencing each other. You see, the decisions made in one part of the world, whether it's a central bank changing interest rates, a country signing a trade agreement, or a corporation announcing its annual profits, can have far-reaching effects. These effects can be seen in the rise and fall of stock prices, the fluctuation of currency values, and even changes in job markets. For instance, if a central bank across the globe decides to raise interest rates, it can lead to a domino effect. This decision can make borrowing more expensive, potentially slowing down economic growth. This slowdown can then affect companies' profits, which can impact their stock prices, affecting investors worldwide. Similarly, a significant trade agreement between two countries can lead to an influx of investments, boosting the economies of the involved nations. This economic growth can reflect positively in the financial markets, leading to a surge in stock prices and potentially creating more job opportunities. It's a fascinating and complex dance where every step, every decision, and every event plays a crucial role in shaping the global economic landscape and the world of financial markets. This dance can sometimes be volatile, with sudden swings and shifts, but it can also be a slow waltz, with gradual changes over time. Understanding this dance, this intricate relationship between the global economy and financial markets, is key to making informed financial decisions. It's about being aware that the money in your pocket is influenced by the rhythm of this global dance, by decisions and events happening thousands of miles away. Indeed, the global economy and financial markets are intertwined in a complex dance. But what steers this intricate dance? What are the key drivers of the global economy? To understand the forces that shape our global economy, we need to consider three principal drivers: gross domestic product growth, inflation, and interest rates. These drivers are like the choreographers of our global economic performance, each influencing the rhythm and tempo in their own unique way. First, let's talk about gross domestic product, or GDP. The GDP is the total value of goods and services produced by a country in a given period. It's a measure of a nation's economic health. When GDP growth is robust, businesses thrive, employment rates go up, and investors are more likely to take risks. Consider the United States in the mid-90s. The tech boom led to a surge in GDP growth, which in turn fueled a bullish stock market. Next, we have inflation. Inflation is the rate at which the general level of prices for goods and services is rising. Moderate inflation is a sign of a healthy economy, as it indicates increased consumer spending. However, high inflation can erode purchasing power and create uncertainty in financial markets. Take the case of Zimbabwe in 2008. Where hyperinflation led to economic instability and a sharp drop in the value of the country's currency. Lastly, let's take a look at interest rates. These are essentially the cost of borrowing money. Central banks manipulate interest rates to control inflation and stabilize the economy. Lower interest rates encourage borrowing and investment, driving economic growth, while higher rates slow down the economy by making borrowing more expensive. A clear example of this is the global financial crisis of 2008. Central banks around the world slashed interest rates to stimulate economic recovery. As you can see, GDP growth, inflation, and interest rates each play a crucial role in shaping the global economy. And as these drivers weave their intricate dance, they influence the ebb and flow of financial markets worldwide. These drivers act as the choreographers of our global economic performance. Now let's shift our focus to the dance floor itself. The financial markets. Like the intricate steps of a dance, the financial markets consist of a complex choreography of various elements, each playing a unique role in the broader financial system. Let's take a closer look. First off, we have the stock markets. Picture a bustling dance hall where companies and investors meet. Companies strut their stuff, showcasing their potential for growth, while investors, with their keen eyes, pick out partners they believe will take them on a profitable journey. In this dance hall, the price of a company's stock reflects the market's perception of its future prospects. Next, we have the bond markets, a more measured and stately dance. Here, governments and corporations seek partners willing to lend them money in exchange for regular interest payments, and the promise of returning the borrowed amount at a future date. The rhythm of this dance is largely influenced by interest rates and inflation expectations. Lastly, we have the currency markets, arguably the most fluid and fast-paced dance of all. Here, national currencies are exchanged, with their value constantly fluctuating based on a myriad of factors, including economic indicators, political events, and market sentiment. It's important to note that these markets don't exist in isolation. They are interconnected, influencing and being influenced by each other in a complex dance that never truly ends. For instance, a rise in interest rates may make bonds more attractive, leading to a shift of investment from stocks to bonds. Similarly, currency values can impact international trade, which in turn affects stock and bond markets. These markets, in essence, are the stages upon which the global economic dance unfolds. Each market, with its unique rhythm and pace, plays a crucial role in the broader financial system, influencing investment decisions, wealth creation, and the overall health of the global economy. Just like a dance, the markets require understanding, practice, and a keen sense of timing to navigate. Whether you're a seasoned dancer or just stepping onto the dance floor for the first time, understanding these markets can help you move in step with the music of the global economy. These markets, in essence, are the stages upon which the global economic dance unfolds. But what happens when the music changes? How do global events impact this dance? Let's take a moment to consider the world stage. It's not just a stage, it's a dance floor, where nations and economies glide and spin in a complex ballet. But sometimes unexpected events can disrupt the rhythm. Geopolitical tensions, economic crises, and natural disasters aren't just headlines in the news. They're sudden, jarring notes in the global symphony, causing a ripple effect across financial markets. Imagine a political standoff between two superpowers. This discord can create uncertainty, which financial markets typically dislike. Investors might react by pulling funds from riskier assets and moving them into safer ones. This shift can cause stock markets to stumble, currency values to fluctuate, and interest rates to wobble. Or consider an economic crisis like a severe recession. Such an event can lead to reduced consumer spending, decreased business investments, and increased unemployment. These factors can directly impact the performance of financial markets, leading to downturns in stock and bond markets. Now let's think about natural disasters. A devastating earthquake or a catastrophic flood can cause significant damage to a country's infrastructure, disrupting production and distribution chains. The immediate aftermath might see a drop in the affected country's stock market and a rise in insurance company stocks. These examples illustrate how global events can cause sudden and significant changes in the financial markets. Investors, in turn, must react to these changes, either by adjusting their strategies or by weathering the storm, hoping for a return to normalcy. Understanding these interactions is crucial. It's like knowing the steps to a dance. When the music changes, the dance changes. And in the global economy, the music can change quickly and unexpectedly. Being able to anticipate these changes or react swiftly when they happen can make the difference between financial success and failure. In this dance, even a slight change in tempo can send shockwaves across the floor. So, how does one stay on their feet amidst these fluctuations? Well, the answer lies in two critical concepts: risk management and diversification. Think of risk management as your personal financial shield. It's about identifying, assessing, and prioritizing financial risks, then taking steps to minimize their impact. Diversification, on the other hand, is your financial safety net. It involves spreading your investments across a variety of assets to reduce exposure to any one investment's potential downfall. Imagine putting all your eggs in one basket and that basket happens to fall. A disaster, right? But if you've spread your eggs across multiple baskets, the fall of one won't wipe out all your eggs. In the context of the global economy's impact on financial markets, these strategies become even more significant. Global events can cause market fluctuations, and having a diversified portfolio can help cushion the blow of these unexpected changes. Yes, navigating this dance requires a careful balance of risk and reward. As we wrap up this exploration, let's reflect on what we've learned. The global economy and financial markets are in a constant state of flux, intricately bound in a complex dance. The key drivers of the global economy, including GDP growth, inflation, and interest rates, have a profound impact on financial markets. We've looked at how various markets, including stocks, bonds, and currencies, each play their unique role within the broader financial system. We've also seen how global events from geopolitical tensions to economic crises can send ripples through these markets. Investors need to respond to these fluctuations with a keen understanding of risk management and the importance of diversification. Staying informed about these ever-evolving relationships is crucial. Follow financial news, consult with experts, and never stop learning. With this understanding, you are now better equipped to navigate the complex dance of the global economy and financial markets.